In this video, I'm going to talk about single premium life insurance. Specifically, I'm going to talk about the income tax on the single life premium insurance because this type of insurance is taxed differently from other type of insurance. So single premium life insurance begins with one payment, typically at least $5,000 and usually not more than $1 million. So basically you pay one single premium, right? Under the term, most policies, there's no further payments. The payments may be applied to your whole life, universal life, and variable life. So basically say, today I won a lottery, so I won $100,000 lottery, so I'm just gonna go to buy a single premium whole life policy. So that's then the rest of all my life I don't need to pay additional premium. So this is a single premium life insurance. So when it's a single premium life insurance, this is purchased if you purchased before June 21st, 1988. So because that was a new law, so then if you purchased this policy before the 1988, so the interest on the single premium is compounded on the tax deferral basis. This means the permitted policyholder can receive this interest income tax-free by taking out cost-free loans. When the insured dies, the death benefit and the remainder of the policy, so you can see there's additional paid-up insurance or retained dividends plus interest. Those things are paid to the beneficiary free of the income tax. So the death benefit, of course, you're going to reduce by the loan and any interest owed. So you can see here, so basically said, well, you have this policy, all the interest within the policy is accumulated, right? You don't need to pay tax for, entire your life year. However, you can take a loan against this policy. So you do not pay, you may pay a little interest, cost-free loans. You can take cost-free loans. So you can see in this structure, then you don't need to pay any income tax, even you have interest received. So when you die, then this all the rest of the death benefit reduced by the loan gonna pay to the beneficiary income tax free. So you can see the whole process you escaped the income tax on this. So because the government notices that, so then, so they changed the law. So we're going to talk about this after you purchase the policy in 1988, right? So before we do that, that's another thing we need to talk about. Say, a disadvantage to the policy is that upon the premature life insurance surrender, due to either lapse or intentional termination, the policyholder is taxed on all the income borrowed over the years plus other earnings that had previously built up in the account. So you can see if you surrender the policy, then all the loan you take out, all the interest on the policy, then you have to pay income tax on it. So that's just something. This is a little example. Here, just say Jill paid a total $35,000 premium. That's the initial premium. Then, right? Then received $3,000 in dividends. It's like interest. Then he take out loan $6,000. Then the cash surrender value and her, or it's her, contract with $44,000. So the tax consequence is investment in contract basically is a new basis. So your initial premium minus the dividends received minus the outstanding loan give you a new basis. You can say the new basis is $26,000. Then your surrender value is $44,000, right? So the gain on the surrender, you $44,000 minus the basis, you give you $18,000. This is ordinary income. So this is a very small amount. So if you can imagine if it's $350,000, right? Then all those things happen is $180,000. Then you will be taxed at ordinary income. That is significant. So some people have, $1 million policy, something like that. So even greater. So that's why you need to know. So holding the policy until insured death is necessary to avoid the potential adverse tax consequences. So yeah, if you have such a policy, just keep in mind, if you take a loan against it, you have to know if you surrender, you have to pay all the interest, pay the tax on all the loan take out. So that's something. One thing we want to know, we just earlier talked about that when you purchased the policy before 1988, you are allowed to take the cost-free loan against the policy. So the whole process you can avoid the tax. However, the government changed the law in 1988. So they created something called MAC, Modified Endowment Contract. So basically, your single premium life contract is a MAC if you purchased after 1988. So in this situation, if it's a MAC, it's a LIFO. So MAC status means that any withdrawal from the policy, including the loans, partial cash withdrawals pledged as a collateral. So all those things will be taxable as ordinary income on the LIFO basis. What is LIFO basis mean is that, well, let's just say you have $500,000 policy, you put a single premium contract, you put $500,000 in it, then then all the you earn all the interest on those $500,000. So if you take a withdrawal, all those interest are gonna coming out first, which means when you withdraw, you have to pay income tax on it. It's ordinary income at your marginal income tax rate. Then if you are younger than 59 and a half, you take a withdrawal, then you are subject to additional 10% early withdrawal penalty as well. Well, so the things is this one kind, if you are single premium contract, if you hold until the insured dies, so that's no those tax consequence here. So you basically your death benefit is to the beneficiary income tax free. So here have a little note that all the MACs issued by the same company to the same policyholder during the calendar year will be treated as one contract. So that's just something keep in mind. If you buy a single premium contract before 1988, you can take a loan against the policy. When you buy the contract is after 1988, so you cannot take a loan, you cannot withdraw cash dividend, you cannot take any other withdrawals. So basically, if you withdraw, you will have significant tax consequence on it. So, however, if you hold until the insured dies, there's no tax consequence. And the death benefit is income tax free to the beneficiary.